Now we're going to turn to the U.S. and look at how is COVID still impacting people's decisions, what is happening in general. But then we want to look at where did the stimulus go? Where do people have savings? How is that impacting jobs? And how willing people are to go back to work, and what does that mean for PMIs, and how is that data being interpreted and really rolled into some of that, not only just top level number, but also the internals, because we continue to see the internals, even though it indicates expansion, it's actually a net negative over the longer term when you look at prices paid, prices received, supply chain and inventory. So those are some nuances that we really want to go into. So this is a Gallup poll that I thought was really good at kind of highlighting some of the intricacies of what we're seeing, where Americans' optimism about coronavirus situation hits a new high. So, people are feeling good. We're almost at the end of this. This is getting to the end. People are starting to feel better. We're starting to see people talk about coming to the office either in July or September, and right now that is progressing pretty steadily. We haven't seen too much adjustment to that. But what are some of the internals? Because this number looks really good, but then some of the other ones I find a little questionable. And let's go through where. So Americans increasingly reporting a return to normalcy from June 14th to 20th. Completely back to normal is only 15%. So then somewhat back to normal is 62%, and not yet back to normal is 23%. So you can see the increase, but this is where people will come and say, well, this is the reopening. The reopening hasn't happened yet, and this is where we're going to get some of that additional demand. But then you get some of the pushback on the other side where, well, if everything's not back to normal, spending is the same or better. You have inflation that is up in different levels. So it's a matter of what is normalcy and how is that normalcy come in? Because, but thinking about your life before the start of COVID, would you say your life right now is, and then completely back to normal? But inflation, I think and this is my conversation and some of the other research I've read, inflation is being blamed on COVID. And I get it to a point, but there's also the inflationary trajectories prior to where we were and where things continue to rise. So how much of that is COVID related, not COVID related, supply chain related? And is that what people are really indicating? Because, realistically, the COVID, people aren't wearing masks anymore, and I'm in New York, which is, center number one. So that's where it's that's an interesting number that I just wanted to throw out there, open for discussion. I have no real opinion on it in general. So now Americans' expectation to their lives that their lives will return to normal. So will get back to normal only 46%, and never get back to normal is 40%. So this is interesting because this is where people have permanently changed their habits. And I think that is true to a certain degree, in the sense of when you look at things that are happening on flex schedule, on spending. So this is where it starts to get into, okay, well, maybe there's still some reopening happening, but for some people, or 40% of those that fill this out, it's never going to get back to normal because we're going to enter a new normal. And so what normal was has now shifted. And that's where that's where I see some of that pushback, just based on the data we're seeing, where you're starting to see a lot of things kind of level off as those who have can and those that don't can't. And that's where we're starting to see this friction point. Now, Americans' views of pandemic in the U.S., in your opinion, is the coronavirus pandemic over in the U.S. or not? So U.S. adults, 71% said that it is not over. Now, males, 64%, females, 78%. And the one thing I thought was interesting was party identification. So Republicans, 43% said it's not over. 66% of independents said it's not over. 96% of Democrats said it's not over. So that's where it's interesting, because I'm New York, obviously a very Democratic state, but I can attest to the fact that things are normal. And this is New York, Long Island, New York City. Things never really got all that bad in upstate New York because, of just the distance. They didn't have the same type of congestion issues. So that's why it's interesting to see a certain backdrop. But the regional backdrop is also interesting because the Northeast, 77% said it's not over. Midwest, 69%. South, 69%, and West, 72%. So this is where you're still getting that piece of caution, and now that the Delta variant is coming, is getting airplay again, and you're seeing COVID back in the news in terms of some of the increase in cases. That's where I think you're, again, that kind of pause as we go through summer and as we start to go into fall. That's where you're going to start to get some of those shifts. But how have people changed? What have we seen over that time period? So let's look at change in wealth by income quintile. So this is I find every time I show this chart or look at this chart, and I think I have it one other place because I find it fascinating. U.S. households added 13.5 trillion in wealth last year, largest increase going back 3 decades. Yet over 70% of the increase went to top 20% of income earners. 1/3 went to the top 1%. So everyone quotes the savings as coming back into the market, but this is the group that were the first to spend, have the means to get a vaccine immediately or want to get a vaccine immediately, and traveled. So what's the follow-on? And that's where I struggle with. What is the follow-on impact? Like, does the next 20% travel? Does the 20% below that? Because we continue to see wage pressure, as we talked about, middle income, lower income. We're starting to see that start to cap and start to see some of those numbers get fairly sticky in terms of unemployment, which again is going to mitigate people's willingness to go out and spend. And we saw that come out in the vacation intended within 6 months. You can see that the vacations have slowed. You have some of that rally out of June into summer, but we're not seeing a big surge. And that's where, when you look at TSA screening, you look at departures, you look at driving data, we're just not getting to that normalcy because people are still, based on their own admission, still not really there yet. And they'd rather go to the park, be in the outdoors, than go stay in a hotel. And not to say that we aren't seeing hotels go back up. We're seeing services pick up. We're starting to see that normalcy, but there's still some of that hindrance. And it's not just COVID. It's also cost. It's also inflation. It's also job security. It's savings. Because even though the savings number is big and splashy, it's not. It's in a very specific group, and that's where I think there's a certain amount of miss in terms of what can actually get pushed into the market. Which is why when people say, "Will things get back to normal?" and 40% say no, never, they're looking at prices. They're looking at the way their life has changed, and people get a little depressed. They get they feel this despair because they see things that they used to be able to afford and now can't, or are struggling to get back to normal. And this is, I think, a manifestation of that as well. But when you look at the conference, the U.S. Conference Board Consumer Confidence Index, it's gotten better. It's not saying that there isn't bright spots, because when you look at the Consumer Confidence Index, up 7.3 points to 127.3 in June, highest since the start of COVID. Present situation up 9 points. Employment optimism has gotten better. Expectations index up 6.1 points. Inflation expectations rose, but still it isn't impacting it fully. So when you look at just where we sit, we're starting to get back to normal, which is good because the confidence is there. It's just it hasn't translated into people saying, look, I'm willing to go, risk it. People are saying they're quitting more. We'll talk about that in a minute. But there's, again, these friction points of some data sets say things are getting really good. Other data sets say, not so fast. And then others are saying, look, it's never going to be the same. Things are going to shift. Not to say that the economy can't grow under a new normal, because what do Americans do? We adapt, we change, we adjust. And it's not just Americans, it's humans in general that will adapt to their environment And this is something to watch to see how does that adoption happen? What does that mean for spending? What does that mean for GDP growth? So then when we look at that consumer confidence index contribution, present employment is the one where people feel confident now that jobs are plentiful. We're seeing more people quit. People feel better about their current employment. They don't feel the need that they have to leave. If they want, they can because they're seeing more jobs out there. But you're also seeing, again, this is driving some of that confidence that we're seeing in general. But then on the ADP side, so payrolls were stronger than expected at 692,000 versus 600. But when you look at the revised, so the previous month, May, was revised from 978 down to 886. Small firms added 215, mid-size 236, large 240. Information was the only sector with a loss. Leisure and hospitality strongest at 332,000. So this is showing, kind of what we were saying, where we're going to get that big spike off the bottom. And then we were going to, go sideways, but we're going to add, but the most of that add came because if you remember what happened in March, you had this big surge in March that isn't reflected in ADP, is reflected in the jobs data, which we'll talk about when they come out. But again, these are some of those pivot points where it's like, okay, well, why aren't people coming back right away? What are some of those hindrances, which I think Indeed did a great job on? There's a thread on Twitter that I had retweeted and they also wrote an article about it. And these are some of those charts from it. So most job seekers aren't looking urgently. Percentage of the population ages 18 to 64. Almost 45% are passively searching. Not open to searching is almost 35%. So when you look at what people are doing, there's no real urgency in the market. And they keep hearing about so many jobs, so much opportunity. So they're thinking about, well, when I want to go back, I'll be able to go back. When things expire, I'll be able to go and get the job that I want. And I think you're starting to see people passively searching, but I want to see this passive become into actively looking. Like, it doesn't have to be urgent. I'm not saying there has to be, you need a job tomorrow, but active looking is going to become a more important indicator going forward. And the job's plentiful. This is telling you that there's more than enough jobs. The labor differential hit the highest level in over 2 decades, pointing to rising confidence in the job market. And this is where, okay, well, but why aren't people going back? What is holding people back? And that's what we're going to look at in the next few slides. Well, let's look at the U.S. as an aggregate. So the U.S. is falling behind in automating its workforce. When you look at the U.S. and just look at the robots per 10,000 workers in manufacturing, you can see Singapore, South Korea is at the far end in general. But what did we see during COVID? We saw a huge increase in CapEx and IT spending for automation, for robotics. So the U.S. has rapidly been losing market share in high-tech manufactured exports. To keep up, it can't rely on cheap labor. It will have to automate, writes the Bloomberg opinion Noah Smith. Other rich countries, business and political elites understand this, and while their populaces are also afraid of job displacement, a number have already installed far more manufacturing robots than the U.S. So this is going to be a means. Remember in segment 1, we talked about birth rate. We talked about the falling amount of workers per the aging populace. This is going to be one of those solutions. But again, this is going to take time. What's happening right now? Well, financial security and COVID-19 behind lack of urgency. Reasons for not urgently job seeking: COVID fears. People are still worried about COVID. The spouse is employed. You still have kids that are home, not back to normal. So, and the spouse has no need to go back given that time period. And the financial cushion is still there. You either have severance, there's no real urgency because you're getting some sort of unemployment, and that's more than enough to make up. So you're not in any urgency to go back. So these are some key things that, again, haven't really changed. And a spouse employed, based on jobs, based on comfort in current positions, if your spouse is employed, well, maybe there's no need to go back. You like family time, you like some of these adjustments, but you also see costs going up. So then, you go from a 2-income family to a 1-income family. Well, maybe you have to go back to 2 income. And that I think is going to become something to watch. But this is where we want to continue to watch. Which states plan to end the pandemic unemployment compensation? So this is looking at who's ending it. So June 10th was Arizona. June 12th, Iowa, Mississippi, Missouri, Alaska. June 19th, Alabama, Idaho, Nebraska, New Hampshire, North Dakota, West Virginia, Wyoming. And then the most recent were Arkansas, Florida. Well, I'll let you read it so I don't have to continue to do it. But you can see that there's more states that are coming off of this excess compensation, which is the hope to push people back to work. Because if it comes down to, I can make $18 sitting at home, or $14 at the office, or at the restaurant, or I can make $20 going to the restaurant, or $18 sitting at home. Is that additional $2 worth getting out of bed, going, not hanging out with friends? And the answer for some is no. So the view is that this is going to change people's means of going back to the office, going back and looking for work. And when you look at the Arbor data, job market heats up, most in states cutting unemployment benefits. So the expectation is that you're going to start to see a pickup in those places that you're seeing that cut, where you saw that spike for June 12th. And it's typically a month ahead, where you see the spike happen a month prior to the end of benefits. And that's what we want to see, what happens with July 3rd to 19th, and what happens June for the first week of July, because so far those have been fairly mutish. And if you think about timing, July 4th, people don't want to go out looking for work yet. So these are going to be some of those impact points that we're going to want to look at and keep track of. So then when we look at people are saying, I quit at a record rate. So now that you have more jobs, you have people that got fired, got let go, needed a job, went right out, got a job. But it was a means to an end. It wasn't a job that they wanted to stay in. So now that there's new jobs, they're interviewing, and they're starting to move on to other types of opportunities, which is going to be, again, something that is positive and showing a strengthening job market. Then when you look at labor market recovers fast, more consumers see jobs abundant. So, I know from personal experience that there have been 8 times that I've gotten to the end of the last round, and the job either no longer existed because they got rid of the position, it was divvied up internally, there was a hiring freeze in that region, or they hired internally. So even though they're abundant, the question is going to be, are they real, or are they just feeling out what prices are and they're actually going to employ someone internally? So these are going to be some of those nuances that we're going to have to work through over that specific time period. So then when we continue to go forward, we want to look at, okay, well, what are the CEOs saying? Well, U.S. Business Roundtable CEO survey, economic outlook is good, capital spending sub-index is good, employment sub-index, all of these things are continuing to drive higher, which again is a net positive to seeing some sort of normalcy coming back into the market in general. And it just means that some companies are willing to open up their pocketbooks and start hiring and feel better about their economic situation. And this looks at it a little bit differently. So let's look at where we sit in the historics. So Outlook Business Roundtable for 2Q have got much better. Hiring plans getting much better. Now the hiring plans are there, but actuality, we're not seeing that roll through. And it's coming down to we're seeing companies that are taking the additional work hours that are needed and are spreading it out amongst those employees currently there versus hiring new ones, because the new individuals want more wages, want higher wages, and they're also worried about their own supply chain. So yes, things are going to get better once the supply chain catches up with everything. And that's where I think we're seeing some of that disconnect between what the plans are and what's actually being executed right now. But it just means that there is some of that backdrop. You will see some of that support going through the remainder of not just this year, but also into next year. Now, when we look at the PMI data and what the underlying PMI data was telling us for the manufacturing, the underlying components, I think, are a bit more important versus the headline, because the headline is obviously good. It was a net positive versus where expectations were. but the supplier delivery times have gotten worse, not better. So we still haven't seen things get better and improve. And remember, we talked about this on Friday, but just to kind of rehash where some of these important levels are for the PMI data set, you can just see the longer delays. The delays are expanding. Things are getting a bit worse. Now, when you look at output prices record high, input prices record high. All of these things are continuing to push down onto the consumer. And if we look at housing, people are already starting to reject those higher prices. So, well, how is that playing out at the more local level? So this is the aggregate. Let's look at the underlying components. So when we look at market news, the Chicago Business Barometer, so it came in at 66.1 after being at 75.2. Now, the business barometer rose at a slower pace, but it's still expanding. Prices paid rose at a faster pace. New orders rose at a slower pace. So orders are slowing, prices paid are going up. Employment fell at a faster pace. Again, employment, what we're hearing and what we're seeing are very different. Now, again, things can change, but that's where we continue to see some of the problems. But inventories fell at a faster pace. Inventories are pulling down. And because there's not enough new inventory to replace it or to keep some of these components, supply chains, assembly lines running, which is also leading to a slowdown in hiring. And then supplier deliveries rose at a faster pace. Production rose at a slower pace. Again, supplier deliveries falling, getting worse. Production rose at a slower pace because production can't produce what you don't have. Order backlogs rose at a slower pace because people are just holding off because they're not seeing a lot of this pull through, which is becoming a bigger problem, resulting in where we think 2021 inflation is going to be. For the rest of the year, we think it's going to be much closer to this high level. When you look at the cumulative, when you look at the monthly, it doesn't take much of a monthly elevated print to get into an elevated level to see inflation at 4%. This is what we talked about last week. Just wanted to reiterate where things sit right now and how we're already on track to easily hit this elevated level of 4%. And the Dallas Fed. So let's look at some of the other intricacies. So manufacturing fell in the Dallas Fed to 31.1 versus the estimate of 32.5 and was 34.9 in the previous month. Now, production, new orders, shipments, and prices paid all up. CapEx fell, employment up small, and 6-month outlook looking strong. So the outlook still looks good, but the internals for right now are continuing to cool off a bit. You're starting to see, again, consumers are starting to reject some of these price increases. Companies are trying to manage cost increases, and that's, again, putting that weight on supply, on hiring. But adjusted retail and food service sales total divided by seasonally adjusted retail inventories, so sales to inventory, is at a record low. And this is a huge problem because this is this is the shortfalls, and this is completely anecdotal, but those that go to Starbucks, I always get a hazelnut iced coffee. They've told me they will not have hazelnut for the rest of the summer. So I'm not saying that I'm going to stop. I'll use something else, but it's just showing that there are so many weird little intricacies, like hazelnut in coffee. I played at a golf outing on Monday, and I needed a new glove, and the gentleman there was saying that they put in an order for new golf gloves. November was when they were going to get filled. So you're just seeing these huge shortfalls. And again, this is just showing that people are buying faster than the supply chain can keep up, which is good for consumption, but it also means prices are going to go higher. Things are going to continue to go out. Companies are price takers, and that's going to, again, lead to those price increases. When we look at the internals, delivery times, again, kind of flatline for Dallas. Then you look at prices paid for raw materials, all-time high. Dallas prices received for finished goods, all-time high. So delivery times are kind of flatlining, but everything continues to push up. And we keep stressing, it's not that we think prices are going to continue to surge up. It's just we don't see anything that tells us they're going to come down. they're just going to kind of stay in this elevated level, especially given how short we are on the inventory side. So when we look at manufacturing supplier delivery time, you can see in Kansas City still remaining elevated. Prices paid, paused a bit. Prices received, paused. Not a huge move down, but again, you're starting to see some of that pause depending on where you're talking about within the U.S. Then when we look at Kansas City manufacturing expected activity in 6 months, everyone is expecting things to be great in 6 months, which I hope they're right. But again, all hope for the future. CapEx expectations going higher. Employee work week is also going up. Again, people doing more with less employees because they're increasing the expected work week of their employees. So say you need someone for an extra 30 hours a week, and you have X amount of employees. Well, if you give each employee that may be working 30 hours a week an extra 3 or 5 hours, they may be happy for the extra cash, and you don't have to hire that additional person. You're just using what's available. So again, these are things that continue to play out. But on just the underlying side of things, when we look at just business conditions, and now this is looking at the world economics, when we look at just what is happening in general, business confidence index is growing, but not at the same pace that you're seeing being talked about. Market growth is flattish. Sales growth, flattish, prices charged. You're seeing a lot of just flatlining, and especially on the staff levels index. So that's where we hear it's going to be good, and there's nothing to doubt them right now. But right at this moment, we're actually seeing some contraction, or at least not the expansion being talked about. But all of that being said, U.S. personal consumption expenditures remain at an elevated level, and you can see they're actually back to pre-COVID, movements, which again is some of this elevated levels, which is starting to come through. But we think that some of this personal consumption will remain high, but it's just going to adjust from durable goods into services, which we'll talk about more in the next segment.